So I'm Robbie from Icehouse Ventures. We're an investment group that's been investing in Kiwi startups since 2003. We've invested in 182 companies and put 115 million into those companies since then. So we're early stage investors. What does that mean? We invest anywhere from, say, $250,000 into ideas, pitch decks, and founding teams to $1.5 million into companies that have product built and revenue offshore. Where do we fit in? We're often happy to be the first check in. We don't need to follow anybody else, nor do we syndicate. But we are not VCs that bring tens of millions of dollars to growth companies. Some of those exist here. Many invest from offshore into New Zealand companies. So in terms of the capital food chain, we talk about founders bringing their own capital or bringing friends and family in. We can fill that next gap from 250 to sort of 1.5 million. And from there, venture funds can invest tens of millions of dollars into a small number of growth companies. And I'm here to talk about the things that investors look for. The first one I want to start with is unique insights or perspectives. So that is founders that are exploiting opportunities or industries that they know because they've been part of them or they've observed them closely. A great local example of that is the team at Avertana. Those guys came out of LanzaTech, which used the intellectual property strategy to extract waste from value at steel mills. They've done a similar thing targeting the solid waste stream at steel mills. So the next one that's pretty obvious is that investors like backing experienced entrepreneurs and teams that have been there. They tend to know the path that they need to go on. They know how to hire, they know how to raise money, they know how to move into new markets. And all of those things serve them well when they're trying to exploit a new opportunity or build a new company. So an example of an experienced entrepreneur in the New Zealand context would be Mike Carden. He and his brother built an HR software company back about 10 years ago called Sonar 6. They raised money, took that into the United States, grew it, and sold it. Mike and his brother have come back and have started a second HR software company called Joyous. So not only do they know the industry that they're moving into and the competitors in the landscape, but they know how to build software businesses from New Zealand and take them to the world. The third thing that we're looking for is startups and companies that are building businesses that are moving into large and durable markets. So what do we mean by that? We mean businesses that are targeting large industries globally or large customer bases globally. So a great local example is Sunfed Meats that's creating plant-based protein. They're not only targeting an industry and a niche that's growing very quickly around the world, as evidenced by the growth of those types of products on supermarket shelves, but they're creating a product that consumers on every continent could purchase. The fourth thing that we like to look for is capital efficiency, or what we say is the ability for founders and companies to make massive strides with limited resource. Going well or going poorly, companies always need more capital, and to get more capital, they need to hit milestones efficiently and effectively. The way that translates into startups is often companies that have founders that can build the product or service and deliver the product or service that they're planning to sell. It is not often resource efficient to have to outsource the development of product or intellectual property to a third party. We also love to see breakthrough technology. What does that mean? That means science or innovation or tech that is literally world leading. Power by Proxy is a great example. They came out of the University of Auckland, where they had spent years developing the intellectual property around wireless power transfer. They became a global leader and outpaced and out-hustled and out-delivered many organizations that were better resourced but didn't have the same intellectual grunt.